I would say this is just kind of a pretty simple way of uh, viewing different asset classes. Cash is very fungible. You can exchange it for a lot of other goods and services very easily, very quickly. Um, and it doesn't really grow naturally. I mean, if you put in a checking account, you're getting like maybe like 14. I think you get like 7 cents on $3,000 or something. Like it's insane. You don't really get any return on it because it's so fungible. Um, so cash is not really going to change much unless the government starts printing a bunch of money and inflating everything, which is part of why I think we saw a lot of people throwing money into the stock market in the last few months and seeing a lot of increases in different commodities. Now Bitcoin, people are kind of treating it like a store of value, like gold or silver, which is a weird thing millennials are doing because they're so afraid of their cash just getting depreciated from the massive amount of monetary supply increase that we've seen from the feds. Government bonds, I'd say those are pretty much worthless right now. The interest rates are ridiculously low. I think back in like the 80s or something, you could get maybe like 7 or even 10% return on them, and now it's like less than 2%. China's actually up competing us here. I think they're up at like 5% right now on their government bonds, which is interesting. And then you have mutual funds and ETFs. Like I said, they're kind of in the same class, but like I said, because of Buffett debt, I really think ETFs are a lot more interesting. Obviously, if you have the right manager, you have the right team, a mutual fund could outperform. So it's not really like the end all be all, but just in general, ETFs, like I said, because they're doing that indexing, you're not exposed to just a single firm. That helps mitigate your risk, kind of keeps you moderate. And we'll look at this a bit later, but the stock market for about the last 90 to 100 years, it's returned about 8 to 12% annually. And so an ETF was a good way of getting exposed to that consistent annual return over long periods of time. Because over short periods of time, we could have a bear market and it's crashing. We could have a bull market and it's going up way too fast. Over long periods of time, an ETF is a great way to get that annual 8 to 12% return. And you got established stocks, large, mid, small. Small, I think technically, might be 100 million. If it's like 100 million to like a billion in market cap, I think that's small. It might be a little different than that. Then mid cap, I think it's like 1 to 5 billion. Large cap, just anything above like 5 billion. And those are so risky, but because they are established and they've got some capital, they've got some history, they've got some financial statements you can go back and you can look at and examine. That mitigates that risk a bit because you're more familiar with their operations, everything. And then you have speculative stuff, cryptocurrencies, new on the block. A lot of people don't understand it. Extremely volatile because of that lack of knowledge that the average person has. Microcap, very small. They don't have history. Recent IPO doesn't have history. There's no financial statements to go back and look at. Penny stocks. We'll talk about that a bit in the breakout later. And basically, they're just has to do with the stock price is the issue. So when you're trying to figure out where on this bar you should kind of focus on, for me, I like to be right in here, right about this 75% of the way up, maybe a little bit to 80. That's just my personal risk tolerance. I can handle a lot of risk. And the big thing is, are you losing sleep? Are you sitting in bed at night on your phone, looking at your account, kind of worrying about how all the bars and graphs are changing, looking at like the last day, the last week, the last month? If that's keeping you from sleeping, then you're definitely exposed to too much risk. And also just be a bit of a novice, and it gets really exciting looking at this stuff all the time. And a little time will go by and get a little more sure with it. Big thing with the high risk stuff, this is big with the cryptocurrencies. I went through this. You also see it with like the Wall Street Bet stuff. It is FOMO, the fear of missing out. When you have something super volatile, because people are seeing over the course of days, weeks, it's doubling, tripling, quadrupling, whatever, and it's crashing back down. And they see that happen a couple times, and they think, "Oh, if I just bought in, and I've been so much better off." But that's hindsight's 2020, and it's very easy to kind of start to get the gambler's fallacy, and start putting money just where you shouldn't. On again something that's very speculative. If you're somebody that's really speculative about that kind of stuff and have that emotional reaction very quickly to seeing success that some people are having like on YouTube that they're talking about, the issue is that when you see those really popular videos or whatever, somebody that's in $100 into like 10,000 or whatever in a couple weeks, that doesn't tell you about thousands or tens of thousands or more people that are getting burned buying it when it's just dramatically inflated in value, just completely unreasonably. And it's just important to keep in mind that where there's that volatility, there's more of that fear of missing out, and that is just a general part of the nature of high risk assets. So if you're like me and you're risk seeking, 120 is pretty good for you. If you're a little more risk moderate, 110. If you're pretty risk averse, then the Rule 100 is good. So the rule is essentially you take your age. So if you're like 30, say this person's 30, they're very risk seeking and they could handle the FOMO and the volatility. They could sleep well, having risky assets, and they would subtract their age from 120. That'd be 90. I mean that 90% of their portfolio should be in equities, which is essentially stocks and ETFs or mutual funds. So you should just kind of have 90% of your holdings should be in here. The 10% could be in like bonds or cash. And I'd say excluding your emergency fund. So we're talking about post-emergency fund. So once you have that set up, then you can start applying these rules. If you're moderate, a moderate risk tolerance, you could do Rule 110. So if you were 30, 80% your portfolio would be in these kinds of assets. And if you're pretty risk averse, you're 30, maybe 70%. Benjamin Graham, in his book, The Intelligent Investor, he also talks about a general rule of never really going above, never having a ratio that's more disproportionate than 75 to 25. You'd never have more than 75% of your portfolio in low risk stuff like bonds. You would never have more than 75% of your portfolio in risky stuff like individual stocks. And he wrote that about 80 years ago. Theories have come up. It's a good one. It's a good way to stay safe, and it's simple. People that don't want to have complex approaches that take a lot of time and effort. And he talks about that a lot in his book. So I think it's interesting. I don't personally apply that part, but it is a good way for people to have a very simple approach. But I think these rules are a little bit, especially if you're young. And last, there's this rule of 72 as far as thinking about how is your money going to grow? How are your investments going to grow? Again, if you're going for like the mutual funds and the passive stuff we're talking about today with dollar cost averaging, you can expect that 8 to 12% return annually, which means over long periods of time, if you're getting that, say, 10% return from these things, what you do is you would divide 72 by 10, and that'll give you the years to double it. So that's 7.2 years. So if you put $100 in, you get that annual growth of 10%. 7.5 years, it'll be 200. And again, we'll look a little bit more at the math